And we are live again. Very good afternoon to all of you once again. And in this session, we are going to start and take care of CCAs, that is cost contribution arrangements. Cost contribution arrangements, which is based upon chapter number 8 of your TP guidelines, right? CCAs. Chapter number 6, intangibles and CCAs, they were discussed in BEPS Action Plan Report number 8. BEPS 1.0, 15 action plan items, 8, 9, 10, aligning TP outcomes with value creation. 8 dealt with intangibles and CCAs. 9 dealt with risk and capital. And 10 dealt with other high risk transactions. So 8 dealt with CCAs and IGS, right? Cost contribution arrangements, they are what do I say? They include within their folds arrangements wherein the M&E group entities, associated entities, they pool their efforts. Cost contribution arrangements, they pool their efforts. And cost contribution arrangements, they are very commonly employed by M&E groups in creation of intangibles. You will see why. Fine. So for the remaining 1 hour 15 minutes which are remaining, we will take up CCA, and then CCA will also carry forward to tomorrow. Tomorrow in the first session we will cover CCA, and then we'll start financial transactions. Then we'll take up that PE, profit attribution, and then post lunch we'll have financial transactions. Fine. Okay. CCAs. The issue, the what do I say? The scope of this chapter. The scope of work of this chapter is to ensure that the conditions of the controlled transactions. What controlled transactions? Those controlled transactions which are part of the CCA, cost contribution arrangement. A, B. These two are M&E entities. These two are M&Es. Fine. These two M&Es, they combine together. They enter into a contractual arrangement. Cost contribution arrangement. CCA is a contractual arrangement. I'll give you the definition. Cost contribution arrangement is a contractual arrangement. So A and B, they enter into a contractual arrangement. For say developing an intangible. This is known as a development CCA. You can have a service CCA, you can have a development CCA. I'll give you. Fine. So during this joint venture sort of arrangement that they have, contractual arrangement that they have, there will be multiple transactions. There will be transactions between A and B. So the scope of this chapter is to ensure that the transactions which are covered, the conditions of the controlled transactions which are covered by this CCA, they are consistent with the arm's length principle. That is, the controlled transactions which are included as a part of the CCA, they should comply with the arm's length principle. How will you ensure that this indeed happens? Very simple. Remember, IGS, the intergroup service, the core principle is the benefits test, and everything can be derived if you understand the benefits test. In case of CCA, the core principle is what? The core principle is there are two participants, participant A and B. The core principle is every participant's share of the contribution. Every participant's proportionate share of the contribution into the CCA should be consistent, should match with that participant's expected share of the proportionate benefits to be received from the CCA. For example, in this development, in this CCA, for this developing intangible that A and B they have created, they have entered into the CCA, it is expected that A will contribute 60% of the, A will make 60% of the contribution and B will make 40% of the contribution in the development of this intangible. This is the contribution, 60-40, contribution. So in order to ensure that the arm's length principle is satisfied, the expected benefits should also be in the same ratio. That is, at the end of the day or during the life of the contract, during the life of this CCA, A should have derived 60% of the benefits and B should have derived 40% of the benefits. This is the benefits. If this matches, contribution and benefits, if this matches, then you will say that the arm's length principle is satisfied for the control transactions covered by this CCA. And your job is done. Ali and Krigan, understood? Yes or no? Yes or no?
Yes.
Perfect?
Yeah.
This is, yeah. So at the very beginning I have given you the entire theme of this chapter. Every participant's proportionate share of the overall contribution to the CCA should be consistent with that participant's proportionate share of the overall expected benefits from the CCA. If this happens, it means arm's length condition will be satisfied and your CCA will pass.